There have been many companies that have intentionally planned to lose money so that they can grow. You can call it investments for the future or a loss leader strategy, but either way, these companies purposely burn through their cash and venture capital funds in the hopes of securing their long-term future. Typically, this aggressive business model has a high rate of failure. There are a lot of elements that need to go right in order for it to succeed. But when it works, it works. In this video, we will examine both sides of the coin and give you 6 examples of modern companies that have both succeeded and failed at this approach. The concept of piling up expenses to drive revenue or increase market share is not a new phenomenon. If a company believes that they have a strong product or service that can be profitable at scale, then they may first try to focus on getting as many customers as they can into their ecosystem. They can price their items below their own costs or use cash incentives to lure customers in. Then, the company can showcase the value and benefits of their offer. With a larger user base, the company can then take advantage of economies of scale to increase their market share or improve profits by raising prices on things that customers now realize they want or need. It could also act as an introduction to the rest of the company's portfolio of goods that customers can upgrade to in the long run. Venture capital firms have taken this approach to the next level with modern tech companies. They have poured in billions in investments with the hopes that one of these startups becomes the next tech unicorn. If given enough time and money, this strategy can prove to be effective. But the company really needs a lot of luck on its side to see it work. It could be derailed by bad timing in a down economy or a fundamental flaw in the whole idea, which could lead straight to bankruptcy. Let's start with some examples of success through this business model. One of the finest examples of a company that intentionally spent more money than it earned is Amazon. The company that Jeff Bezos started in his garage in 1994 is famous for not turning a steady profit for 10 years as internet retail continued to mature. Amazon's vision was to be the go-to e-commerce marketplace, but the market and technology was not quite ready yet. But Amazon's executives and its investors were quite patient, especially knowing that their strategy to become the leader in online retail could pay off extremely well if it worked. They could all sense that the e-commerce revolution was coming. So, Amazon invested heavily on improving their technological infrastructure, acquiring other smaller online retailers, and spending tons on marketing their brand. Despite losing roughly $3 billion through 2002, their overall plan was working, as revenues rose to $5 billion by 2003, and the company turned their first profit of $35 million that year. The rest is history, as Amazon continued to grow their market share and improve on their efficiencies, resulting in revenues that are now $500 billion per year. Meanwhile, their net income is also a lot healthier, averaging $15 billion over the last 5 years and reaching a record high of $33 billion in 2021. Therefore, Amazon's strategy to invest heavily in an emerging market that is now worth $5 trillion has certainly paid off. Another company that deliberately lost money in order to secure future profits is Tesla. Founded in 2003, the company knew that they couldn't compete with Ford or Toyota if they needed to mass-produce cars using the same process and technology. The only chance Tesla had was to design and build their own state-of-the-art manufacturing process, and to sell their cars directly to consumers instead of through a dealership network. So, that is exactly what they did. From 2010 to 2020, Tesla reinvested the bulk of their free cash flow back into R&D, totaling $8.5 billion during that time span. At one point, they spent about 18% of their total revenue on R&D, which is 3 times more than the automotive industry average. But that led to almost $6 billion of losses in the same period. That meant Tesla was losing about $4,000 for every Model S sedan it was selling at the time. Still, their plan eventually paid off. Tesla constructed multiple gigafactories and continued to perfect their technology and production line to make it cheaper to build cars, all while the cost of developing batteries also declined. At the same time, demand for electric vehicles continued to grow. Finally, by 2020, Tesla was profitable for the first time, posting an annual gain of $690 million. Their finances have continued to improve as well, as they are now earning $9,000 of gross profit for every car they build. Meanwhile, Toyota only makes about $1,200 per vehicle. That has led to a $12 billion profit for Tesla in 2022. Therefore, investing in the right technology and process has paid off tremendously for Tesla. Our third example highlights a company that implements this strategy on a portion of their product line instead of the whole business. Costco is known for offering high-quality bulk items at wholesale prices, which has helped them to develop a very loyal following. To provide their customers with a great all-around experience, Costco also offers an affordable and tasty food court in all of their stores. If you take a closer look at their menu, you will see some prices that are downright illogical in today's market. Their famous hot dog and soda combo costs just $1.50, a price that hasn't budged since it was introduced in the 1980s. Around the store, you can also find their budget-friendly rotisserie chickens that cost just $4.99. If you factor in inflation and the rising cost of labor, there is almost no way that Costco is making any money when they sell these products. But that is exactly their goal. In reality, Costco doesn't care if they make money on these items. Instead, they do it to entice shoppers to visit their store, where they will undoubtedly buy more than just hot dogs and chicken. These loss leader products also give customers the feeling that they scored a great deal and leave them with a positive memory of the store in their minds. It also causes customers to associate the Costco brand with a good value as well. So, by purposely selling hot dogs for a loss, Costco is actually generating more revenue and securing long-term brand loyalty with their customers. Now, we will take a look at 3 companies that have tried the same approach, but have not been successful in establishing a profitable business. Our first example of spending gone wrong is DoorDash. Surprised to see this food delivery company on the wrong side of profitability, even though they charge such exorbitant delivery fees? Well, let's dive into their business model. What does DoorDash actually sell? They don't own any restaurants, nor do they employ any full-time drivers. Instead, they sell a digital service that connects hungry customers with local restaurants through freelance delivery workers. So, what makes DoorDash different from, say, Uber Eats or Grubhub? In reality, not much. Food delivery companies are generally an undifferentiated commodity service. The quality of the food and speed of the delivery doesn't come from DoorDash, but rather the restaurants and the deliverers. Meanwhile, you would probably just choose the app that offers you the lowest cost for the same meal. Therefore, it is just a race to capture the biggest market share and the most number of customers to become profitable. DoorDash is currently winning that race, with a roughly 50 to 60% market share of the online food delivery market. But that distinction has come at a hefty price. To differentiate themselves, DoorDash has needed to spend a lot on customer acquisition. That's why you are always getting promotions for a $10 off coupon or 25% off your next order. It is estimated that they spend roughly 30 to 40% of their revenue on marketing alone, which is much higher than the average 10% seen in a typical business. Although they generate over $6 billion a year now, they have never been profitable. In fact, DoorDash has routinely lost $500 million per year since going public in 2020, and it's not getting much better. In 2022, they actually lost $2 million every single day. DoorDash has already established a dominant market share, yet they still cannot turn a profit. Therefore, we're not sure how much longer investors will want to keep injecting cash into a business model that does not seem to be improving. The next company on our list is WeWork, which is known for offering co-working spaces. WeWork was founded in 2010, just as the sharing economy, online schools, and digital nomads became more popular. Due to the swelling demand for office space for this growing market, many large investors lined up to help fund this half real estate, half tech startup. Over the next 10 years, they were able to raise a staggering $21.9 billion from big names like SoftBank and BlackRock. Their revenue growth was also quite impressive, reaching a high of $3.4 billion by 2019. However, their operating costs were through the roof. WeWork's main costs are tied to developing and running co-working spaces. That includes the cost to lease and furnish offices. But somehow, those costs have routinely surpassed their revenue, resulting in a cumulative loss of almost $21 billion since their inception. That is the second highest loss for a startup in history. In other words, WeWork has been actively buying their revenue with massive investments, but with seemingly no positive outcome for their long-term health. Today, their stock trades for around $1 or $2, which could be a signal of how sustainable the market believes that this model can continue on for. If you think WeWork's losses are impressive, then let us introduce you to the company that has squandered the most money in the history of all startups. That company is Uber. Uber was launched in 2009 as one of the original industry disruptors, specifically in the transportation space. Their rideshare platform then expanded to the food industry with Uber Eats, as well as to the logistics business. Their steady growth in all three segments has led to at least $1 billion of revenue each year since 2015, even reaching $30 billion by 2022. However, despite their strong brand recognition and revenue growth, Uber has only been profitable one time in the past 10 years. Their core business model, which they would never admit to, was to establish a foothold in every major city and then undercut the taxi companies by offering cheaper fares. If you look back at the early 2010s, you can now understand why or how your Uber fares were so cheap. Essentially, the company was subsidizing each trip to make them seem more competitive compared to a traditional taxi. Once they could drive out the competition, Uber would then capitalize on each market by raising prices to what is actually a sustainable amount, thus creating their own taxi monopoly. But phase 1 of this plan requires a ton of cash to execute well. To date, Uber has raised over $25 billion from investors and private equity firms, but has burned through a record $32 billion in cumulative losses. That gives them the distinction of the startup that has lost the most money ever, and it seems that it was all on purpose to try to drive out all of the taxi competitors so that they could have sole possession of the market. Along the way, Uber has also faced regulatory pressures, internal investigations on their workplace culture, and general backlash from their surge pricing model and driver wages. Meanwhile, the taxi industry has experienced a bit of a resurgence as Uber's prices are now sometimes even higher than a yellow cab's. It's been over 10 years now, but Uber's plan does not seem like it's working. We believe that this approach is quite risky and probably should not be replicated in today's economic environment where it is getting harder to fundraise. These days, the prudent strategy should be to grow organically in gradual steps, instead of just getting as big as possible first and then worrying about profiting later. What are your thoughts? Are you surprised how much money some of these companies have spent, sometimes with no profits to show for it? Let us know in the comments below, and please like this video and subscribe to our channel. Your support helps push us to keep researching these fascinating topics so that we can all learn something new. As always, thanks for watching.